so this is a little bit of a change of pace. This is much earlier stage work than most of what we've been seeing today. And it also is not dealing directly with a lot of the corporate governance issues, but rather with financial regulation, which of course supports and informs corporate governance in important ways. So this is joint work with Dan Ulrey. My main claim, our main claim in this paper is that there's a fundamental tension, a disconnect between the nature of finance and how we go about regulating finance. The primary reason we should care is this really compromises the quality of financial regulation we get. But there's also a number of other costs in terms of overinvestment of resources when we just don't have the information that we need to make informed decisions, and also adverse consequences in terms of legitimacy and buy-in and the other aims that the processes through which we regulate finance are meant to achieve. All right, so today I'm going to spend a little time right at the beginning just talking about the nature of modern finance, the fact that the financial system is dynamic, that it's complex, and that unknowns pervade. Individually, none of these I don't think are controversial statements, but most people treat them as kind of after-the-fact considerations. So like, oh yeah, we know it's complex. Oh yeah, we know it's going to respond to regulation in certain types of ways, but we treat these as things that we can deal with after the fact. And fundamental to our claim is that these are not second order, but rather first order in the nature of finance. So after going through that, we're going to acknowledge that there's a range of applications that come from that, and then we're going to look at, well, what is the process through which we regulate finance? So this is kind of political process and political economy 101. Like, what are the actual mechanisms through which we go about creating the rules that govern the financial system? And we're going to see a mismatch there because we're going to see rules where they put a heavy, heavy burden on ex-ante process. So lots and lots of discussion ahead of time, and then frictions that make it very, very difficult to change the rules after the fact. And then we're going to go through a couple of case studies that try to bring to life what we see as this tension, this incompleteness between the nature of finance and how we're going about regulating it. And since we don't want to leave just a negative story, we're also going to think about, well, how might we do better? And this is the effort to try to think about how might Eastern medicine, not as a substitute, but as a complement to Western medicine. So Eastern regulation as a complement, a more holistic approach to regulation as a complement to the tools that we're currently using to try to regulate the financial system. All right, so as I said, first characteristic of the financial system that we want to put front and center is its dynamism. So the first thing to note is that periods of stability in financial markets are not static. It's been formalized in different ways. We have the leverage cycle, we have the credit cycle, but what these different models show is that when you have a period of stable activity that actually changes volatility, which is an input, in a whole variety of different models in ways that you have changes in asset prices, changes in leverage, and oftentimes spillovers in terms of structural changes spilling over from the changes in asset prices and the changes in leverage. Second, regulatory arbitrage. Again, I think this is well established, and you can put different normative spins on it, but as we go in and as we try to regulate, that regulation imposes cost. Oftentimes, there's ways to reconstruct economically similar activity, but in ways that are subject to a different regulatory treatment. So we see a migration of activity into different firms and into slightly different forms as a response to regulation. So the regulatory perimeter and what's happening within the regulatory perimeter is oftentimes shifting over time. Innovation. Again, the hyper on fintech right now is the latest discussion, but we have seen significant changes in how we regulate and also significant changes in technology that have implications for how we go about making decisions as credit decisions and creating different types of financial instruments. And a lot of people say that right now, I think in particular, with big data and AI, there's a possibility of more disruptive and more significant changes in terms of what's happening both in the market, but also potential tools to regulators. And then finally, as we'll talk about a little bit more later on, there is always the possibility of radical change, more significant changes that are actually very hard to foresee for reasons that could be either within or outside of finance. Second, financial markets are complex. Financial institutions are complex, financial instruments are complex, financial markets are complex, and the way that these all work together as a system oftentimes is complex. All right, so let's start by looking at banks. And again, this is dated, but it really hasn't changed that much since 2013. So we see, prior to the crisis, a massive increase in both the size and the complexity of GSIBs. These are the 29 largest banks worldwide. And then it levels off a little bit after the crisis. Of course, during the crisis, one of the ways we stabilized the system was to have very large institutions buying other very large institutions. So there was no shrinkage then, and we really haven't made progress in terms of shrinking and sunset. So legal subsidiaries is a imperfect proxy, but nonetheless a helpful proxy. And what we see is your average GSIB has about 1,000 different subsidiaries. The other thing to note is first, these subsidiaries are oftentimes operating worldwide, so they're operating in a whole variety of different jurisdictions, subject to different rules for that reason. They are also operating in different spaces. So yes, a lot of those subsidiaries are banks, but other ones are insurance companies. Others are asset managers or trust or other types of financial subsidiaries, other types of non-financial subsidiaries. So these institutions are massively complex. And one of the things we've inadvertently learned through the stress test process is this has significant and oftentimes adverse consequences in terms of the ability of even top management to understand everything that's going on inside these institutions. So let's look at instruments. And again, this is dated because it's only after the fact that you get the really pretty pictures. And I want to summarize it quickly. So this is a pretty picture of CDOs. And what we have here are a bunch of different houses of mortgages that are going to be individually made. Then you're going to have waterfalls. Those waterfall terms were specific to the MBS. So they were different across each of these different instruments. And they said depending on the performance and what number of houses that are mortgages that are in default and not, well, we're going to pay money to this tranche and this tranche, but we'll stop the flows to this tranche, or we'll let the tranches flow to this tranche. So you had specific waterfalls. They were idiosyncratic. And then you would have cash flows depending on the cash flows into the very tranches here, tranches into the CDO. And then, of course, we have the CDO squared. Today, we don't have mortgages as the source of concern. Instead, it's leveraged lending. But nonetheless, we have significant concerns about leveraged lending. And of course, that's flowing through CLOs. And CLOs that have terms that are not materially all that less complex than what we saw here. I was on another call last week trying to understand, as we lose LIBOR, what are going to be the implications for a whole variety of bespoke options and various bespoke types of derivatives. And the truth is, for a lot of them, you really need to figure out if the parties can figure out a way to cash out, because they're so complex that there's simply no way to go from an interbank rate to the risk-free rate that's going to subsidize for LIBOR and have the actual transaction make any sense. So we still have incredibly complex instruments today. And of course, the shadow banking system. So this is the idea that not only do we have these complex pieces, but they come together and they interact in ways that we don't fully understand. So this is the shadow banking system circa 2008. Nobody saw this as a system in 2008. Nobody had this picture in 2008. If they did, a lot of headaches would have been avoided. This was not created as an academic exercise. This was created up on the wall of Zoltan Pozner's office when he was at the New York Fed. And what they were trying to do was to try to figure out, wait, there's a problem over here, and that's creating a problem over here, and we didn't foresee that. What is the nature of that interaction? Oh, wait, we're trying to provide liquidity support here. It's not creating the systemic effects we want to. What are the frictions impeding that? Oh, wait, we have to go over here. So what we see here is basically what we would today consider a market-based system of intermediations, but there were a bunch of different interconnections that nobody had appreciated until the tide went out. And again, if you look at the numbers today, we still have market-based intermediation. It operates slightly differently. We don't have as many off-balance sheet vehicles, but nonetheless, the system has evolved. It hasn't disappeared. The last characteristic I want to highlight are unknowns. So the first just flows what I'm talking about. You have a system that is very complex and that is constantly changing, and where it's costly to produce information, it's costly to produce data. Both market participants and regulators are going to be operating with only a subset of the data points that are potentially pertinent in various states of the world to the decisions that they're making. So they're going to gather up the data they can and then rely on proxies when they potentially need to, just because of the complexity and the rate of speed in terms of how things change. Second, this has been kind of a pet cause of Mervyn King, but others have highlighted it as well, that there is this constant challenge that there could be what he calls radical uncertainty. So the biggest challenge, as he puts it, is the inability to conceive. These are the unknown unknowns, as opposed to the first category, which are kind of the known unknowns of the way radical uncertainty could actually change and bring about changes that today we can't even begin to conceive of. And the last, and this is, I think, an important additional point, and is qualitatively different, comes from Rich Clarida. So of course, he's now the number 2 at the Fed. He sent this to me when he was still at Columbia, and he described it as the only time he'll ever write a FinReg paper. But I actually think he hit on one of the critical points. it would seem that the supervision and regulation of US investment in commercial banks during the Great Moderation was based on an assumption about how the financial system was supposed to work, not upon sufficient knowledge about how the financial system actually worked. And so what I see him saying there is they had limited data points, but they're also understanding the data that they had through an outdated model. And the data wasn't sufficiently inconsistent with that model that it forced them to fundamentally rethink and to examine through a different lens how it is they ought to understand where systemic risk might be growing in the system. So we have unknowns that are just a byproduct of the fact that the system's very complex and it's changing quickly. We have the possibility of change that could be disruptive and significant, but there's also the possibility, and this is consistent with a lot of the work that's been done on experts and why experts are actually very bad at forecasting. They are looking at the data, looking at the information they have through lenses that are potentially outdated. So we see these as fundamental just to the nature of modern finance. So just as an acknowledgement, once you put these front and center, there are a variety of different reasons we might be concerned about them. And so some of my earlier work deals with some of the other reasons that we might want to care about these dynamics. And a lot of that flows from the fact that traditionally, we understood intermediation as primarily happening in a bank setting. So a lot of the models trying to understand the way information can contribute to runs and other sources of fragility are focused on information dynamics that assume information asymmetries, where there's information that managers have that bank depositors don't. We shift instead to a world where you have incredibly complex financial institutions and a lot of intermediation happening through disparate but interconnected entities in a market-based system. The information dynamics start to look different. And there can be situations where you have reliance on proxies. As proxies become less reliable, that can create its own source of fragilities. And it also creates challenges for regulators, because a lot of tools we've traditionally used have said, oh, we care about liquidity versus solvency. Well, there's going to be lack of information about some of those variables during a period of stress. So I want to acknowledge there's a bunch of reasons we might care about these different characteristics of the financial system. What we're focusing on, for purposes of this paper, is what are the implications for how we go about regulating finance? What are the implications for how we go about creating those ex-ante set of rules that are going to govern the financial system? So let's look a little bit at this process. This one I'm going to keep a little bit shorter because I think it's not only less controversial, but also fairly well known. So oftentimes you have a broad framework that is established through IFR, through International Financial Regulation. We have IOSCO and a bunch of different bodies. The most important and pertinent for the work that we're doing is oftentimes Basel. We're going to look at it a little more closely later on, but you basically have a very resource-intensive process that is largely technocratic, but it's technocratic with a lot of political constraints in terms of what it is they're thinking about. A lot of discussion over exactly how we ought to be dealing with what we have identified as the various market failures we're trying to rectify. And then after you've adopted particular rules, processes that make it very difficult to change what those rules are going to look like. Those rules are not self-executing. Instead, states have to go back and actually adopt the rules. In the US, it happens you go back to Congress. As a matter of constitutional requirements in the US, we have what we call bicameral approval and presentment. That means you have to have the majority of the Senate, which is 100 members, a majority of Congress, which has 435 members, sign the exact same bill into law, and then you have to have the president agree to it, or if not, you have to get a supermajority from both those houses. It is meant to make it intentionally hard to create law and to have a lot of different hearings, a lot of different discussion, with the idea that we can put all the big issues on the table, figure out, well, what are the major trade-offs that we care about, and create accountability because all this is happening in a public setting. And then there's a bunch of other frictions that added to that. After things go through the statutory process, then they go through a rulemaking process. This is what happens at the agency level. So this is what the Fed or the SEC. So as detailed as statutes are, you still actually need those translated into even more detailed regulations. And again, we're going to look into more detail, but it's a very time-consuming process where they come up with a proposed rule, they solicit broad sets of comments on it, they engage in a bunch of studies, and they eventually issue a rule that then becomes very hard to change. And to the extent they're trying to bring rigor into it in the financial regulatory space, it's usually through efforts to try to quantify the costs and benefits, not necessarily think about it in structural terms. There is some dynamism at the edges. There are things like supervision and discretion where they're trying to go in and on a firm-by-firm basis, try to figure out what is the risk taking, how can we go about it. But one of the big themes after the crisis is there's distrust at all these different levels. So at Basel, people don't necessarily trust other countries to create standards that are sufficiently rigorous, so they want rules, and increasingly detailed rules. Congress doesn't necessarily trust agencies, so they create very detailed statutes. And at this point, a lot of the rules that are coming out of the agencies are very, very detailed. So we do have some discretionary mechanisms, but those mechanisms tend to be on the margins as opposed to the core to financial regulation, in a significant part because of distrust associated with them, and also because of concerns over how effective they are given the complexity. So there's a separate line of literature that says bank supervision worked really well when banks were simple. It doesn't work so well today just because the institutions have gotten so much more complex. All right, so I would already say that there's a little bit of a tension there, the system that's very complex, very dynamic, and then processes where we're going to create a perfect high-quality rule ahead of time because we're going to gather all the information without knowing how the system's going to change in response to that rule, and very likely without even the current information that might be relevant. So let's look at money market mutual funds. So as you might recall, we had the failure of Lehman Brothers that called the reserve primary fund to break the buck. That means that it went below the $1 net asset value, and then we stabilized the system through massive support from the Federal Reserve and the Treasury Department, and then afterwards everybody said, well, that's no good. We don't like government backstops. If it's going to require a government backstop, maybe we ought to do something about this. Jeff, I think, actually wrote one of the op-eds that came under this nice, very graphic for the Wall Street Journal. So they didn't need to do anything in Dodd-Frank, so it was clear that the SEC had the authority. SEC sat on their hands for a long time, but everybody's like, you have to do something, you have to do something. So engaged in a lot of discussion. So finally, 5 years after the bailout, 3 years after Dodd-Frank was passed, after there'd been a lot of internal discussion, they said, okay, here's our proposed rule. So they issued hundreds of pages of discussion. They said, we've done all this study. Here's what we think is best. Here's what we've defined as the open questions. They then got comment letters back. They got 1,400 comment letters. About 1,000 of those were form letters, but 400 very, very detailed, thoughtful comments from industry participants, from other regulators, saying, here's what we think about, or you should do it like this, or you should do it like this. Lots and lots of discussion, and an incredibly detailed final rule, almost 900 pages, over 2,500 footnotes. Okay, here are the changes, and this is why we think that this rule is the best rule. All right, so what did they talk about? There's a lot of attention on market discipline. We think this is going to enhance market discipline. That's going to be great. Some attention to systemic ramifications, but basically said, look, there probably will be some. We can't predict what they are, and so we're not even going to try to make any effort to identify what are the different issues we ought to be looking at because it's beyond our power to predict. So we're just going to zero it out since we can't figure it out. And there's this thing called the Federal Home Loan Bank System. It appears once. Footnote 893, where basically they're defining government money market mutual funds. So just by way of background, the way money market mutual funds work in the US is you have retail funds held by us, then you have institutional funds held by institutional players. Within the institutional space, you have government and prime held the private assets. The run after Lehman Brothers were institutional prime. So the reform was just on the institutional prime. So this is what the discussion looked like after lots and lots of investment. So what happened? They had assumed here that, look, given the heterogeneity of investors, we do not expect all investors to allocate to the same alternative. So instead, they're going to go all over the place. It turns out they're wrong. They did not go all over the place. They went to exactly one place. That was actually within the same fund family. They went from the institutional prime fund to the government fund. So we see that money market funds stayed incredibly stable overall, but what there is this is what the area that was subject to the new rules. Nobody liked it, so everybody just jumped over and became a holder of government money market funds. How was this possible? The Federal Home Loan Banks came into the rescue. So Federal Home Banks are a GSE, which I can talk about more. If you know my prior work, I'm not a fan of them. I've never gone about trying to write about the Federal Home Loan Banks. But in the United States, if you're interested in how subsidies are provided to banks and how liquidity support is provided to banks, you're oftentimes going to suddenly find the Federal Home Banks right there. They are an incredibly poor-run set of 12 organizations that are an off-balance sheet vehicle of the United States government, but nonetheless manage to provide a lot of support for banks and a little kickoff for community housing. So what did they do? They started issuing a lot of short-term debt. And where did that short-term debt go? Right into money market mutual funds. So suddenly we have this interdependence. Here we have money market mutual funds suddenly holding a lot of Federal Home Loan Banks bonds. And here what we see is that they become much more dependent on money market mutual funds as a source of funding. And so what is the net effect? It used to be banks would issue commercial paper. that commercial paper would be held by the prime funds. Now, banks instead borrow from the Federal Home Loan Banks, and they fund that borrowing by putting money into the government funds. So we ended up with less market discipline and greater government activity because the government is now intervening between these two different areas. I'm not going to go into all of this, even though I'd love to. This interacted with a change in the liquidity rules governing banks. So basically, the way that they were able to handle all this increased funding is that banks suddenly were very happy to hold all these assets, not only because they couldn't go to money market mutual funds for funding, but now there's these new liquidity rules. They wanted longer-term funding. Well, guess what? The Federal Home Banks could do that. So we have now a much bigger Federal Home Loan Bank system, and a Federal Home Loan Bank system that's not only bigger, but is taking on significantly more liquidity risk because there's a significantly greater liquidity mismatch between the assets and the liabilities. So now we have an outcome no one predicted, and there's crickets. We discussed it for years, but now we actually know what happened, and there is something here that I think we should debate. I'm not a huge fan of them. Other people might say this is a good thing, but we're not actually discussing it because it's going to be too hard to change the rule. And so this is what I think is the asymmetry between a system that's going to change in ways that are hard to predict and the fact that we invest all of our effort ahead of time in trying to figure out what the rules are. All right, so I'm running short on time. So Basel rules, let's just say they get increasingly more complex. And I spend most of my time at banking conferences. Every single banking conference I go to, there is at least one paper on how the liquidity coverage ratio is having all of these unintended consequences, both in terms of assets and in terms of how banks are funding themselves. You go to the net stable funding ratio, which is the other thing that they did. The consequences are going to be even more dramatic. We just haven't managed to finalize it yet. So there's incredibly detailed rules, which have a whole range of unintended consequences, partly because they interact in a bunch of ways that nobody actually sees ahead of time, because we're trying to figure out step by step, oh, we're worried about liquidity, so we're going to introduce a liquidity ratio. Oh, we're worried about the GSIBs, so we're going to have a GSIB surcharge. Oh, we're worried that the capital ratios are pro-cyclical, so we're going to have a counter-cyclical surcharge. So there's a bunch of problems. We identify all those problems, and we try to solve those problems in isolation based on what we know just about this area without thinking about the overall system. Then can we do better? The long and short of it is we've made some progress already, but I would say we haven't gone nearly as far as we should on the types of changes that would actually address these dynamics. And then there's other proposals out there. I think there's valued each of them, but limits each of them. And so the question here is, can we do better? And how might Eastern medicine do that? And just by way of this definition, again, we take something that's a complex system and we break it down into parts because we want to bring rigor to it. So it's not an argument against that. I think we need that rigor. I think we need that knowledge. I think that has to be part of how we go about both understanding finance and how we regulate finance, but that's going to be fundamentally incomplete when there's interactions in other parts of the system. So what we want to suggest is we have to figure out how to institutionalize a way to complement these piece-by-piece efforts with an additional process that's going to give people an idea of maybe I don't need to overinvest now because I'll have a second bite at the apple eventually. And so first of all, I'd say partly it's a mindset. The stress tests as they're currently being done are feeding overconfidence because you're coming out with things like the president or the chair of the Fed saying, we know that in this horrible adverse macroeconomic situation, all of our banks are going to be very well capitalized and they're going to be well positioned to lend. No, the stress test is a test. It's a model. It gives us incomplete information about what's going to happen, and we have to be able to understand it as such. So part of the Eastern medicine approach is recognizing all of these different tools give us information. The information they give us is incomplete, and we need to understand it in a contextualized way. So if instead we use stress tests and say, look, here's the outcome we're getting. Here's what the bank's getting. There's a big gap between those two. What is that telling us about what we don't know, interactions we ought to be preparing about, is going to be a more productive approach to doing that. Other approach, which we're still working on, is that we're thinking about something like a 10-year commission. So again, a lot of the other proposals are ones that look at things like constant updating. I don't want constant updating in financial regulatory spaces. Most people don't. So what we're trying to figure out is something like some kind of interval that's a reasonable interval where we could say, okay, looking back over the past decade, what's worked, what hasn't worked, why, what have been the unintended consequences, is RegTech actually developing in ways that create new opportunities that didn't exist previously, and then have this done, again, through multidisciplinary conversation and a way that involves public feedback. It's going to ideally be done in a way where the government provides significant financial support along with informational support and a big microphone. But then Congress is going to have the ability to come in or not come in subject to public pressure. But so we're trying to figure out what are the ways where we could actually institutionalize, say, learning mechanisms, and how can we do this in ways that might have positive spillover effects, where a lot of the problems that are currently happening or what we see as the limitations in the processes, where there's less of investment to overinvest. But not only that, in rulemaking, are people willing to say, look, here's what we know, here are the things that we don't know, and here are the things we potentially ought to be looking at in the future. So rather than have vacuous, conclusory statements, because that's actually assumed to be a conclusion, recognize that basically all financial regulation is experimentation. It is experimentation. And so if we can be more honest about that, we can start to understand, well, how can we potentially go back and create additional changes? So I'm done. Just so this is a nice illustration by Andy Lowe and somebody else, a bunch of colleagues. And what they're doing is they're basically using the tool that you would use to assess, do you have well-constructed computer code, to look at the US code, our legal code. This is Title 12. This, at the time that they wrote this was second to the tax code in terms of, no, this is really bad code. This is code that is so complex that is going to break down. And I'd say at this point, given the tax reforms, this is probably the worst. And so it's not about regulation or deregulation, but how can we actually increase the quality to achieve the desired goals?
Thank you. This is an interesting and provocative paper, and I thought because I'm at the end of the day here and you're tired, I have 4 slides and I can do them in 10 minutes max. So let me first just summarize the basic claims that are going throughout the paper. There's a fundamental mismatch, that's the basic argument in the paper, between the complexity and the dynamics of finance on the one side, and the aims of predictability and stability that the law should bring. And if you don't do that carefully, then you have the negative impact that you modify the law, but you increase complexity and you increase the dynamics of financial markets, which is the reverse effect that you were expecting. And how can we do this? Well, we could do that and having commissions that are set up every 10 years, and they try to fix the system. Okay? Let me try to poke at those things here. So first of all, it seems that predictability and stability in financial regulation is a good per se. I can figure that one out. Because if you have a monopolistic system, maybe it works, maybe, right? But we have regulatory competition. So as soon as we introduce regulatory competition, I don't see exactly how you can achieve that. So that would be the first point. Second, I always thought that legal uncertainty is a good thing. The lawyers hate it, that I get, right? But the markets love uncertainty because to some extent, you never know exactly what tomorrow is going to be. With legal certainty, you fix yesterday, not tomorrow. So I'm not pushing it to the extent saying that law should be uncertain by definition. But some uncertainty risk, who should care, who should applaud it? And I think that you should consider that point. It would definitely be an advantage. And actually, what I would also encourage you to do is to look at the empirical foundations of legal certainty and what it brings and what it couldn't bring. And in particular, you have to distinguish between legal uncertainty and changes in circumstances that suddenly make the legal regime much less predictable than it used to be. And finally, if you want to talk about certainty, the bureaucrats and the judges that sit around there, they're not going to be exactly predictable. They have different tastes, different preferences, and that affects the equation. So that would be my first point, that I buy a bit less this predictability and stability advantage. Of course, I'm not saying that I don't want it at all, but I would be much more moderate in it than you are. The second point is that if you do regulation badly, it would increase system dynamics and complexity in a negative way. And therefore, we have to be careful in what we do there. So if you look at first the dynamic effect, the dynamic perspective, it seems to me that the paper argues against arbitrage. But regulatory arbitrage, again, might be a good thing if regulation is not per definition efficient, and it cannot be bad per se. That's number one. And number two, when the regulation is ineffective or bad, it might be just that markets have changed. So we don't know exactly what the direction of the foundation is. Same thing with complexity. You say markets are complex, but what do you mean by that? What are the data supporting, what is really complexity and what isn't it? And especially when you look at complexity, it's again not clear to me whether regulation increases or decreases complexity as such, so I'm diagnostic. it's true that regulatory imbalances might increase uncertainty. Well, if it's a known unknown, well, one more, one less, I would be indifferent. It's true that if it increases the unknown unknowns, that would be more of a problem, and I think you should dwell on that. I'm not totally sure how you could have unknowns and knowns with regulation, but it's certainly possible, and that would, I think, reinforce the case. Finally, my last slide, a commission to fix things. Now, I mean that you mean commission in a generic way. You mean a body, right, that could be set up and do it. And I think it's a really interesting example. You provide also some suggestions, but then the question is, if you want to set them up every 10 years, what does that mean? Do they start from scratch? In which case they have to assemble data, hiring, hearings, hire people. That takes 5 years. They have to think about it. An additional 2 years. They have to have hearings again. An additional 3 years, and the 10 years are gone, right? So I'm not sure about what you do with this. And then do they have decision-making powers? If they have them, that's a real progress. If it's another blah blah in the concert of voices, zero value. So this is politically much more difficult to decide because you have to fix this. And then who's going to be this new great guy sitting on a commission, right? The usual yo-yos that run around and pontificate, or a young guy who has a lot of idea, but then he'll never get on the commission, or some social-minded, whatever it is. Now, one solution would be to have one great guy. That would be good. Bernanke and that kind of stuff. Then you could do this. But again, good luck in finding him at the right time. But every 10 years, if you look globally, maybe you should work on it. But then it raises serious governance issues, right? You need, basically what you're saying, you need a dictator, which I look to favorably because dictatorship has its advantages in many areas, actually. So that could be one of the things. Finally, also, what you want to poke at is something that is increasingly important is the role of technology in financial regulation. So first of all, you could harness blockchain technology to have decentralized decision-making across various regulatory authorities, and you would have more secure, more independent, more secretive decision-makings and results. That could be fun. I don't think it's politically viable, but that would be one way looking at things. And the second thing, which is also of increasingly importance, is how do you harness artificial intelligence in the process. Now, regulatory bodies increasingly look at artificial intelligence to enforce regulation. You can learn and have machines deciding which cases, factual cases, fill the prohibition of the law. And actually, some major consulting firms have done fantastic research showing, for example, that if you have on the left side what's legal, on the right side what's legal, if you use artificial intelligence, you are better able to identify what you should prosecute. And it's different than what people do. Now, if you start doing this, you have artificial intelligence making enforcement decisions, right? If you let artificial intelligence make these enforcement decisions, they make law at the same time, because what is enforced is what the law is. And then you can say goodbye to those guys again here running around. So you have again to think into, if you have artificial intelligence making law, maybe your commission or what you are talking about might be, café von gestern, as they say here in Frankfurt, which might mean coffee from yesterday, which is not the best coffee on the planet. So that's, I'm pushing it here, but that's something else that you might want to consider as a commission. And that would be for my presentation.
So just a couple of quick responses to that. So first, for predictability and stability, I think we did not convey our claim clearly enough. We were not saying anything about the desirability or lack of desirability in terms of the predictability and stability of financial regulation as such. Our suggestion was that if you look at the nature of the processes through which we make rules, those processes assume that we can have a lot of discussion ahead of time, and that discussion is going to be informed and meaningful, because we know that that discussion is actually going to relate to what the long-term consequences are going to be. So we're assuming that the system is relatively stable, that if we intervene in a particular way, we can have a discussion today, and it's going to be an informed discussion of should we use tool A or tool B to try to achieve a desired outcome, because we actually know something about the relative benefits and drawbacks of tool A and tool B. And so we're not talking about the predictability and stability of financial regulation, but the way the processes that are currently used implicitly assume predictability and stability in terms of the nature of the financial system for those processes to actually achieve the aims that they are intended to achieve in terms of legitimacy, in terms of getting buy-in from the different constituencies. All of that requires the conversation today to actually be about what's going to happen. In terms of the normative lens on complexity and dynamism, this is an important point. And I think we are at least somewhat agnostic on some of these issues with respect to the dynamism. I think part of what we're just trying to say here is once you recognize that this is part of finance, then we need to think about different processes through which we regulate finance, not inherently whether it's good or bad. You're right that we probably do have a little bit of this negative connotation when it comes to complexity. And again, I wouldn't say it's complexity as such. I think complexity is oftentimes a byproduct of efforts to do things that can have a lot of benefits. So there's a lot of reasons things are complex. But there's different types of complexity. And so the reason I ended with that issue of that picture from Title 12 is what we've seen in the US is it's not just periods of regulation that introduce complexity, it's deregulation. So everybody thinks about the 1980s and 90s as being these periods of massive deregulation. Title 12 continued to get more complicated. So what happened then is banks actually didn't want uncertainty. They wanted certainty. So people said, well, maybe there's some synergies or some possible gains if banks are allowed to do this additional thing that they weren't allowed to do. So we'll create a rule that says they can do that. And maybe there's some gains from creating an additional rule allowing them to do this. And what can do this? So what we've done is we have this, the reason it's so messy, the code is so messy and the regulations are even messier, is we keep incrementally saying we've learned this, so we're either going to create a new prohibition or a new allowance or a new exception. And for each way, we keep incrementally adding a bunch of detailed rules, but they interact. And they interact, and we're not taking a step back to say, can this overall regime potentially be rationalized in ways where there could be potential benefits? So I think part of the suggestion is not that complexity is bad per se, but complexity that is a byproduct of a bunch of incremental and narrow-minded efforts to either increase or reduce the regulatory burden can aggregate in ways that result in a complexity begetting complexity, both institutionally in terms of the private firms and in terms of the nature of the regulatory scheme. The Commission, I think there's a lot of questions on all these things, and we should keep thinking about them. In terms of the new type of thinking, so what we're thinking right now, and again, this is going to be speculative, but if you look at the kind of the literature, a lot of regulation is effectively an effort at forecasting, right? And so if you look at what are considered wicked problems, and a wicked problem in the design thinking literature is a problem where there's just a lot of ambiguity, actually specialists are very bad at those. So what you want is either a generalist or a diverse group of specialists. And so part of the reason we're going to the health context is we had for a little while really bad science leading to bad policy. So we know that people eating like way too much dietary fat resulted in people actually having more heart disease. So we said, oh, you should eat less fat, and those were the dietary guidelines. Well, guess what? People reduced the amount of proportionate fat in their diets by increasing massively the amount of carbs that they consumed. And so we did end up with a kind of a leveling of heart disease, but type 2 diabetes and a bunch of other health outcomes that we also care about skyrocketed simultaneously. So now what do? They have processes, there it happens every 5 years as opposed to 10, where they constitute commissions for 18 months to 2 years. They bring together a new group of experts every time they do one of these things. It's a diverse group of experts. And they basically do a massive literature review with a lot of government support in terms of coming up with the materials. And then they produce a very detailed report. And they say, here's what the rules are now. Here's where we think they're right. Here's where we think there's shortcomings. They don't actually have rulemaking authority. And then there's still a political process of thinking about the trade-offs through which those recommendations are translated into guidelines, and people are concerned about the effect of industry. But nonetheless, that then creates a conversation where every time they issue new guidelines, you have people in the public saying, look, they deviated. This is what the commission, the experts recommended, and here's where they deviated. Or here's what the expert said was going to be the effect of this. So it creates a different mechanism for accountability. So is it a perfect process? Probably not. But particularly where there's a lot of these interactions, And we're seeing it a lot with both capital and a lot of the liquidity requirements, where it's just this never-ending complexity and a lot of consequences. I think most people would say maybe those are undesirable. There's no ability to try to rationalize. So are there mechanisms to which we can say, where are some low-hanging fruit where you can potentially rationalize, particularly when these things are interacting in ways that we had not particularly originally foreseen?
Before we go left to right that way, I'll make a few mistakes. It's wonderful that we end the day with something that makes me think of it's quantum regulation, because as it's Heisenberg, as soon as we look at it, it changes.
Yeah, just concerning the dynamism, I think it's important to distinguish between two aspects of it. I mean, a lot of the dynamism is just responding to the latest regulations to figure out where they are them. And that, there is a game that the regulators can't win because they don't have the personnel to win it. On the other hand, there is the dynamism, which is innovation. But I think the evolution of the regulations is kind of squashing that, at least in the US. If you look at innovation in the financial sector in the US compared to what you see in some of the
Asia,
other countries, the US seems to be suffering.
Just a question to know how your holistic approach would pick up the fact that historically financial systems look quite differently across economies. So part of the complexity that comes out of the Basel Committee essentially is due to the fact that nations are affected asymmetrically by certain rules, and this is why there's an exception, and then there's an exception to the exception. So I'm not sure how the holistic approach could deal with that fact that you're not starting from scratch, essentially.
Yeah, so just a quick comment. So yeah, I mean, I think you're not starting from scratch. But I think that's, for me, more reason that we need to at least have these conversations and get the issues out on the table. Because going back, again, to the regulatory arbitrage, I see the international dynamics as another critical way that we get regulatory arbitrage, right? It's not a closed system. It's never going to be a closed system. So instead of idealizing it as a closed system and saying, well, what rules would be imposed if we had a closed system, we have to say, okay, this dynamic, it's going to keep changing. And then we're going to have to refigure it out again. And that's why you're doing this potentially every decade, is we don't think that there's going to be answers. We don't think, and this goes back to regulatory arbitrage, there's never going to be lasting answers. And we're not going to try to create perfect rules. We're going to realize the rules are inherently, at best, second best, and that are going to become more incomplete over time. But once we recognize that they're second best rules and they're going to become even more incomplete and ineffective over time, can we institutionalize a mechanism to at least create some kind of partial updating, dealing with the regulatory perimeter issues that you're dealing with, and dealing with the fact that activity might migrate in particular types of ways. So I think these are both significant challenges. And this proposal is not meant to be a complete solution. It's saying here's a complement that could allow us to at least do better than we are doing. Because I think right now we are imposing regulations that are incredibly, incredibly costly to try to comply with. There are effects on innovation and elsewhere. And I think there are some benefits, but there's also potentially some cost. But there's just no will whatsoever to try to figure out if we can do better, because everyone's just exhausted.
So, Kate, I'm trying to figure out how you'd make the Commission's recommendations, give them some kind of bite. And so one question is, would you favor some kind of sunset provision for the underlying regulations?
Yeah, no, and that is one of the biggest questions. And the short answer is I don't favor sunsets because the system is already designed to be deregulatory. Adding something that is additionally deregulatory isn't going to rectify the problem. And if you look at the literature on Congress and kind of the political economy, oftentimes when you have something like a sunset, instead of actually revisiting and engaging in meaningful learning, what they do is we get a bunch of additional sausage making, and you get little benefits left and right without actual reconsideration. So this is one of the real challenges. I think the best that we can do is give them, like I said, like a really, really, really big megaphone, and potentially require something like, and this is what we require in other places, like 2 days of hearings. So say like, okay, you're going to be able to do all of this, and then you're going to report, and you're going to say, here are the recommendations we have, and maybe some of it will be sufficiently non-controversial. Like here are ways we could just rethink, the interactions between the LCR and the and what qualifies as HQLA and how these things interact. Some things might be more controversial, but it's at least forcing Congress's attention and ideally public attention on these matters and recognizing that there might be trade-offs that we need to think about differently. But I think the political economy point is a really critical one, but we just are not yet ready. I'm not yet ready to say that we should force Congress's hand, because if they're not interested in doing it, the outcome can be really bad.
So, Kate, you make this into an epistemic issue that's special to finance, and that's a mismatch of regulation. And I wonder on all 3 points whether that's so specific to finance. You know, like the internet has changed so many things, and now we have privacy issues with Facebook and political influence. I mean, stuff changes in the world, and regulation has to react. It seems to me pretty constant in many walks of life, not special to finance. And then, how does it change? It was interesting, your slide with how it changes. Bicameral response, notice and comment. Yeah, that's in the United States. I don't think that's how a French bureaucrat would think about it. That's not how an English bureaucrat would think about it, because they can move faster. They also have the sorts of commissions, I think, in England, all these reviews that they publish, the megaphone, they have that already. And so I wonder whether that's really the issue, because of course things go wrong in the UK as well, even though they can move faster. And so I wonder, is it really epistemic, or is it the will to do something? I mean, you know, the US bank regulators knew fully well that the banks were skirting the capital rules before the financial crisis, but they thought it was a good thing. And the federal home loan banks now, I don't know if they know what they're doing, but for sure they don't need legislative authority to issue less short-term debt. And so on and so on. We could go on. You know, I mean, I think there is, if the regulators wanted to, they could do lots of stuff already. And they know a lot of problems, but they don't act. So that's
Yeah, no, it's perfect. So actually, so both of them. So first of all, a lot of these dynamics are not specific to finance. So that's part of the reason we've actually spent a lot of time looking at models outside of finance. The challenge is a lot of the more interesting models that have come out, and experimentalism is probably the one that's been one of the more important, assume all we're dealing with is a challenge of unknown. So we're going to produce updating mechanisms where you have kind of a centralized node, and then you have decentralized information gathering and constant updating of rules to get through the unknowns, but that assumes some commonality of interest. So it's effectively what we had with Basel II, where we said we're going to let banks use these, their internal efforts at risk management, and we're going to piggyback off this internal management and create this kind of cooperative effort to work with banks to improve overall risk management. What happened after the crisis is everybody said, we don't trust that. So there's a bunch of other really interesting models to deal with unknowns and dynamism outside of finance. Virtually all of them require some level of trust and some faith in commonality of aim between the centralized node and the mechanisms lower down. And at least in the post-crisis period, which is different than beforehand, we don't have that. So I agree with you that we should be looking elsewhere. Internationally, we should also be looking elsewhere. And this goes back to kind of to Merritt's point. And we have, Dan's currently at Oxford, so we're clearly looking at it. But there is also the political economy. You're right, it forces people, do we have the ability to force people to do things when everything looks good? And this is always the constant challenge of finance. It's when everything looks good that actually the problems are growing. So what this does at least is it creates a spotlight and says, look, you really need to think about these things. And one of the big challenges as well is the problems current regulators don't have a lot of incentive. This is the problem with forbearance, to say, oh, it turns out that there's risks within the institutions that we're overseeing that we actually hadn't paid attention to. Or it turns out there was a bunch of migration that we haven't brought your attention to otherwise. So what this does is bringing in outsiders, which I think is different than in France or in England. You're right, they can make regulation, but you still don't have any inside participants who want to be the ones saying, look, there's a bunch of problems that you're not adequately dealing with. So I still think in those settings that having outside experts come in and have the massive information gathering authority from regulatory bodies and from institutions and coming up with an independent report of, okay, here, bringing a different view and a different perspective, here are potentially ways to rationalize or improve or update the regulatory regime in order to further identified aims, could still serve a very important purpose.
So I have a lot of sympathy to your story, but I think that you have to start the whole story about 20 or 30 years earlier, because the system that we had before the crisis was a result of an attempt to simplify greatly the system that was before. So in the old days, let's say 1970s, bank regulation was very, very complicated. No one understood how it worked. Monetary policy was very complicated, relied on econometric models with thousands of equations, and people wanted to simplify it and said, why do we have to get into so much detail? If we just force enough equity into the banks, that will solve everything. That will replace all the little regulations that we had before. And by the early 2000s, people were very confident that we have achieved it. At the same time, monetary policy became simple, just Taylor rule. And I remember very well that about a year before the crisis, I attended a financial stability conference at the LSE. There was a Bank of England guy, and he said, we estimated the probability of default for the Royal Bank of Scotland. It's once in 1,000 years. We are all set. And then the complication came when the system didn't work.
And I'm still trying, so there was the great moderation, which you are pointing out well, and I think is well established. I mean, one of the big challenges was all of this, and this goes back to also why things like experimentalism aren't great. What they're assuming there is the feedback mechanisms you get are probative of the outcomes you care about. And one of the big challenges in finance quite often is the feedback mechanisms might actually be enabling additional risk-taking in ways that simply aren't coming up in the models you're using, so there's fundamental shortcomings in how we're thinking about these things. But if you just look quantitatively at the number of pages, either in Basel, in the statutory scheme, in the regulatory scheme, I don't think I ever see a period of simplification. And there's a really nice book that's actually looking at the period of deregulation in the US, basically showing that actually no, institutions became far more complex during that period of time, and regulations became far more complex. So I agree that there was an effort to kind of allow greater freedom and a focus on like capital as a potential substitute for close supervision, but I don't think it was actually about simplification. And I wouldn't say monetary policy right now is in any way simple. If you look at, the Fed has guidance. It's definitely not, we're just going to follow the Taylor rule. And there's some big gaps between what they do and the Taylor rule.
I'm not saying that monetary policy now is simple. It's very complicated. But monetary policy before the crisis was perceived to be very simple. Everyone said, all the banks are doing is following the Taylor rule. And that looked, on the face of it at least, simple. And Basel I wasn't that complicated. It was Basel II and Basel III that became more complicated. But Basel I was an attempt to simplify a system that existed before.
I think what Basel I was an effort to say we actually I think it was dealing with a Hurst failure, and it was an effort to say we don't trust individual countries, so we're going to create something at the international level, but it was very simple, partly because they needed agreement among big group. But I think your bigger point is actually consistent with mine, and I think that's one of the challenges, is there's both this information challenge, but there's also how are we understanding that information challenge. And so part of what I'm suggesting is maybe getting a group of experts with very different backgrounds to come in and ask a bunch of questions and give them a bunch of data, you might be able to say, look, should we be thinking about things different than we are? And again, we've tried to institutionalize this with all these like annual systemic risk analyses, but that's very different than thinking both over can we make regulation more efficient and what are the shortcomings. And this is an effort to think about both. It's an effort to think not in pro-regulatory or deregulatory terms, but how can we rationalize or update the system in ways that better address the risks, but that means also trying to understand where they are. So again, I think it's an incomplete solution, but I think what you're suggesting, and partly is the mindset solution, as a mindset challenge, that this would not potentially fully rectify, but could at least potentially counterbalance. But we should talk further. I'd love to.
We've got 3 more questions coming forward, and here's what I propose. We take
Take them
questions.
all. Yep.
And then we take the answers all at once. Jeff?
So doesn't the present experience with OFR and FSOC kind of cast a pessimistic light over the effort to have a dynamic system that updates on a decade basis, right? One of the distinctive elements of Dodd-Frank was to have, in effect, a body, OFR, collecting information, and FSOC that would have responsibility to monitor the financial system as it evolves and suggest need to intervene. And what we've seen is barely before, the baby began to walk, Politics has now cut back both the scope of what OFR does and, of course, has converted FSOC into, a talk shop, which is, and indeed, the current proposal is to limit the space over stuff it can talk even more, right? So doesn't that add kind of a pessimistic prior as to the ability to build in sort of a dynamic review? One person's failure is another person's rent. That's what we learned, right? There's no reason for the money market funds to exist except that they existed. And a lot of folks had substantial investments in them, so question mark.
Thank you. So, very briefly, I think a holistic approach would require you to focus not only on how to make rule-making better, but also supervisory action better. And so I was somewhat disappointed to see that you only focus on the 10-year plan for better regulation, because that will be totally useless unless you improve the way then supervisor act. And there you have a fundamental problem of the information they have access to. You can do a lot nowadays. There's a lot of bad literature now on RegTech, but I think you and Dan are in the best position to say something meaningful on how to use it. And second, there is the question of the incentives of these people who will sit on top of lots of information, may not have the human capital that is needed, but they may also lack the incentives that then you need to act upon it in the right way. I think without that, your paper is incomplete.
Okay. Many thanks. I have to say that I highly appreciated a number of your observations, particularly with regard to the process of regulating the deficits, which sometimes are very evident in the level of analysis which is done before tools are enacted. There is oftentimes, it's more of a trial and error process than it is a really in-depth analysis of advantages and disadvantages, and particularly also an inclusion of unintended consequences analysis. I however think that there are, in today's world, there are regulatory processes which start to pick up on the holistic approach. So to give you an example, in the aftermath of the crisis, all the financial standard setters were asked to analyze systemic risk in their area, including also in insurance, the International Association of Insurance Supervisors. And that resulted in a framework which was designed to identify firms who, in insurance terms, exceptional basis, were generating systemic risk. After some experience having been gained with this framework, it was realized that this is not the whole truth. You need to take into account also activities of a number of firms, particular activities which are pursued by several firms. So this leads now to a draft of a holistic, really literally called a holistic framework of supervision of systemic risk in insurance. However, the question still arises, how holistic is holistic? So, in other words, where do you draw the borderlines on what you have to take into account and what is manageable to be taken into account?
All right, so the quick answer to Jeff's point is yes, the OFR and the FSOC have not lived up to what we hoped they would be, but I think there's a very easy political economy explanation for those things, and that is we managed to put the FSOC under the charge of the Treasury. We put the OFR within the Treasury. And then at the start of the OFR, we had a Treasury Secretary, Tim Geithner, who was adamantly opposed to the creation of the OFR and did everything he could to impede its getting off the ground. And then we had a new president come in who also has zero faith in the OFR and started firing people left and right. So you have a tiny organization housed within a bigger organization that wants a small one to fail. That's a recipe for failure. And same thing, they're the head of the FSOC. And not only that, one of the things we didn't think about when we created the FSOC is FSOC is the new body in the United States that was an effort to say, look, markets and prudential regulators aren't really doing different things now that we have market-based intermediation. We need conversation among these very different regulatory bodies. But what they weren't thinking about is that even though most of those, many of the oversight bodies are multi-party commissions, the heads are of the party of the president. So then you have actually much more rather than less groupthink, because you have a president appointing a bunch of people who all think about the problem the same way to a bunch of different regulatory agencies, and then they come in and they think about the problem in the exact same way. And part of what I'm trying to suggest here is actually we need something that's truly outside of that. So they're thinking about these things in actually qualitatively different ways. So I think that doubled down the existing system rather than trying to create something outside the system. I'm going to actually answer the other questions as related to one another. Because I think how holistic is a core question, because you're not going to get everything, right? So I think we need to think more in structural terms. We need to think bigger picture. But as a practical matter, if you try to map the financial system, you don't want to create a map that is as complex as the system. So we're necessarily going to, and this is where I actually think the analogy to something like the health setting is very helpful, because effectively they define for themselves what's going to be important. So for example, last time they came out with the guidelines, they decided sustainability was something that was important. So they added sustainability to the scope of their gambit. But they could also define more narrowly what they're going to engage in. So I think what you'd have to do is choose very good experts, and then they would have to say, after some initial period of study, here's the scope of what we're trying to look at. And then that would have to be kind of what they choose to focus on. And then that, I think, would be related to Luca's point. I think supervision is very often going to have to be part of this. So we're not trying to exclude supervision. It's merely we're trying to think right here in big picture terms. It is a somewhat, it already is a methodologically quite messy paper. And so we're trying to think, okay, the big challenge that we see is a regulatory process where we spend a huge amount of effort discussing issues that turn out not to be the issue. And we're trying to figure, and then you end up with a bunch of rules that interact in ways that nobody foresaw, and that have, I think, what most people at times agree upon are unintended consequences and costs. So we're trying to think just what are in big picture ways to create some improvements, some rationalization on the system. But these have all been very, very helpful. So thank you all so much, and I look forward to talking to you further.